Maximize your borrowing power. Unraveling the secrets of your credit score. When it comes to applying for a loan, whether it's a mortgage, car loan, or personal loan, your credit score plays a crucial role. Lenders use this score to assess the risk associated with lending you money and to determine the terms and conditions of your loan. A credit score is a numerical representation of your credit worthiness, reflecting your financial history, borrowing behavior, and ability to repay debts. In other words, your credit score can make or break your chances of obtaining a loan and significantly impact the interest rates you'll be offered. Understanding the importance of your credit score and taking steps to maintain and improve it can be key to securing favorable loan options and achieving your financial goals. The following are the most important factors that influence your credit score: payment history, credit utilization, length of credit history, total credit lines and credit mix, and new credit applications. The pie chart below shows how your credit score is calculated. We will now review each category in more detail. First up is payment history. Payment history is the most significant factor affecting your credit score. It refers to whether you have a history of making your payments on time, including credit card bills, loan installments, and other debts. Late payments, delinquencies, defaults, and bankruptcies can have a significant negative impact on your credit score. These derogatory marks indicate a history of financial difficulty and can remain on your credit report for several years. Payment history makes up 35% of your credit score. Next is credit utilization. This ratio represents the amount of credit you're using compared to your total available credit. It is calculated by dividing your outstanding credit balances by your credit limits. The total amount you owe across all your credit accounts affects your credit score. Higher outstanding balances may indicate a higher credit risk. It's important to manage your debts responsibly and aim to keep your balances as low as possible relative to your credit limits. It's advisable to keep your credit utilization ratio below 30% to maintain a good credit score. Credit utilization makes up 30% of your credit score. Next is credit history. The length of your credit history is an important factor in determining your credit score. It considers the age of your oldest credit account, the average age of all your accounts, and the time since your most recent activity. A longer credit history demonstrates a track record of responsible credit management and positively affects your score. Length of credit history makes up 15% of your credit score. Next up is total credit line and credit mix. Lenders prefer to see a mix of different types of credit accounts, such as credit cards, mortgages, auto loans, and personal loans. Having a diverse credit mix indicates your ability to handle various types of credit responsibly. However, it's important not to open new accounts solely to diversify your credit mix, as this may negatively impact your credit score in the short term. Total credit lines and credit mix make up 10% of your credit score. The final category is new credit applications or hard credit inquiries. Applying for multiple new credit accounts within a short period can raise concerns about your financial stability and may indicate a higher credit risk. Each credit application results in a hard inquiry on your credit report, which can slightly lower your credit score. It's advisable to apply for credit only when necessary and to space out applications over time. New credit applications or total hard inquiries make up 10% of your credit score. Now, let's look at how most lenders view credit scores. A credit score between 800 to 850 is deemed excellent. People in this range have an extended history of using credit responsibly. They usually use a small percentage of the credit available to them, and therefore it is easier for them to secure credit at the very best rates. A credit score between 740 to 799 is deemed very good. Individuals in this range have demonstrated a history of positive credit behavior and have an easier time being approved for additional credit. It is usually at competitive rates. A credit score between 670 to 739 is deemed good. Generally, lenders consider applicants with credit scores in this range to be acceptable or mid-risk borrowers. They can usually obtain credit, but at slightly higher rates. A credit score between 580 to 669 is deemed fair. Borrowers in this range are frequently referred to as subprime borrowers. They are viewed as higher-risk borrowers by lenders, and they might struggle to obtain additional credit. If it is obtained, it is usually at higher rates. A credit score between 300 to 579 is deemed poor. People in this category frequently struggle to have new credit approved. If your credit ratings fall into this low range, you probably won't be able to get any new credit until you take actions to raise your scores. In conclusion, I hope this presentation sheds some light on the factors that make up your credit score. Understanding these factors can help you make informed decisions and take appropriate actions to improve and maintain a good credit score. By practicing responsible financial habits, such as making timely payments, keeping your credit utilization low, and managing your debts wisely, you can positively impact your credit worthiness over time. Thanks for joining us today. Remember, the more you learn about the mortgage process, the better informed you will be when you need to get a loan. Until next time, don't forget to hit that like button and subscribe to stay updated with the latest in mortgage information. Feel free to share with anyone you feel would find this video informative. This video presentation was produced by Chuck Borjoli, NMLS, number 2189710. Have a good day.